Okay, in this video, we're going to go through bond valuation. And so this takes the perspective of an investor in a company's bonds. So a company is issuing bonds to investors, and investors are buying bonds from the company. In addition to you could buy a bond from a company, these bonds also trade in secondary markets. So investors are buying and selling bonds with each other, okay? And this video is all about how are investors valuing these bonds? So how do they decide how much they're willing to pay to invest in the bonds of a company? And they do this by discounting the future value, future cash flows that they're expected to receive from the company. And let me show you how this works using our made-up example of a bond issued by a company called Boosted Board. Boosted Board was an early stage company that made these electric skateboards, and they eventually went out of business. And so they went bankrupt. But you can imagine a company trying to raise money, to grow their operations. One way they might do this is by setting up this long-term debt contract called a bond. And so they might issue this bond to investors, and then investors would pay the company money in return for this sheet of paper, promising investors future cash flows. So first thing we need to do to value this bond, so Boosted Board offers this bond and investors buy it. So how should investors determine how much to pay for it? Well, we're going to convert the terms of this bond into a schedule of future cash flows. This bond is being issued on January 1st, 2018. It's got a term of 3 years. So they're borrowing the money for 3 years. The face value of the bond is $100,000. Now, face value means that at the end of the 3 years, if you are holding this bond contract, you'll be paid $100,000. This face value is sometimes called the maturity value, since it's paid at the maturity date. And sometimes it's called the principal. So anyway, this $100,000 is paid at the maturity date, which is 3 years from the issuance date. And then each year that goes by during the bond contract, a Boosted Board is going to make coupon payments or regular interest payments of 5% of the face value. So they're going to make $5,000 coupon payments each of the 3 years that goes by under the bond contract. And those coupon payments will be made annually. Okay. Anyway, what the investors will do is they'll read the contract. Let's assume we're valuing the contract as of January 1st, 2018. And what they'll do is they'll convert the terms of the contract into a schedule, which shows you what cash flows are expected to occur as long as Boosted Board stays in business, doesn't go bankrupt or fail to make these interest payments. These are the payments you should expect to receive from investing in the bond. So you should expect to receive at the end of the first year, which is December 31st, 2018, a $5,000 coupon payment. Same thing at the end of the second year. And at the end of the third year, you get that final $5,000 coupon payment, but you also receive face value or the maturity value payment, because this is the maturity date of the bond. It's 3 years after the issue date. So the first thing investors did is they converted the terms of the bond into a schedule of future cash flows. Now the question is, what are these future cash flows worth to me today? Today being January 1st, 2018. So now what I'll do is I'll go to a spreadsheet and I'll show you how I might value or compute what I think it's worth to receive those future cash flows from Boosted Board. So let's go into a spreadsheet. Here we are. And what I'll put in this yellow box on the spreadsheet here are the details of the contract. So there's a $100,000 face value on this contract, and the coupon rate is 5%. 5%. Okay, great. And what I'm going to do is convert these terms into the payments that I'm expecting, and this is the same as we did before. So at the end of the first year, I get a coupon payment. So that's equal to 5% times the face value. At the end of the second year, I get another coupon payment, 5% of the face value. At the end of the third year, I get another coupon payment, 5% of the face value. But I'm putting parentheses around it because in addition to that, I also receive the face value as a lump sum payment at the maturity date of the bond. So there's that schedule of future cash flows that we talked about before. And what investors are doing, so the company has determined what goes into this yellow box. These are the terms of the contract. What investors need to determine is what rate of return do they need to invest in this company. So the company specified a coupon rate, but that could be more than investors need, more return than the investors need, or it could fall short of what investors need in terms of return on their investment. So Boosted Board is actually a pretty risky company. And 5%, I'm just going to assume that this 5% is not sufficient rate of return for me to lend money to Boosted Board. Okay, it's risky. It's riskier than that. If I'm going to invest in Boosted Board, I need a 6% return on my investment in order to make that risky investment. This is the risk return trade-off. Okay. And what investors do after they select an effective interest rate, they'll discount these cash flows using the effective interest rate that they've selected. So this $5,000 1 year from now, what is that worth using a 6% discount rate? Well, the formula is take the future value and divide it by 1 plus the interest rate raised to the power of the number of years away the payment is. So I'll take the future value, which is 5,000, and I'll divide it by 1 plus this discount rate, okay? So 1 plus 6%, but I'm going to raise that denominator to the power of 1 since that cash flow is 1 year away. In fact, maybe I'll just write 1 so you can see it, okay? So I'm taking the future value over 1 plus the discount rate raised to the power of 1. Now this second payment is 2 years away, so I'll take that same future value and I'll divide it by 1 plus the discount rate. But this time I'm raising the denominator to the power of 2 because that next payment is 2 years away. And so what you're seeing, now let's compare these numbers. This 4717, that's what $5,000 1 year from now is worth to me today at a 6% discount rate. The same $5,000, but 2 years away, is worth even less. It's only worth $4,450. That's because I would rather have $5,000 1 year from now than $5,000 2 years from now. That's why the present value of the first payment is higher than the present value of the second payment. And then the third year payment is $105,000 future value. I'll divide it by 1 plus the discount rate again, 6%. This time I'm raising it to the power of 3. The denominator is raised to the power of 3 since it's 3 years away. And that $105,000 3-year ahead payment, discounted at 6%, is worth $88,160. And now it's simple. So I have 3 future payments. What are they worth to me today? Well, these are the present values. So I'll just add them up. So I'll take the sum of these 3 numbers and I get 97,327. Okay. That's what, if you're an investor and you want a 6% rate of return, you should pay $97,327 for this bond that the company is offering. And just to really hammer this point home, so what is the investor going to receive? Well, on January 1st, 2018, the investor is going to pay $97,327. So I'm going to show that as a cash outflow from the investor's perspective. And then the next 1 year goes by, you receive $5,000. 1 year goes by, you receive $5,000. And 1 more year goes by and you receive $105,000. So in total, let's add these up and look towards the bottom. The sum of these numbers is positive 17,673. That's how much that's the net cash inflow to the investor. Okay. But what the question is what is the return on investment to this investor? And to calculate that, we can use an Excel formula called the internal rate of return, the IRR. What is the internal rate of return of investing 97,327 and then getting 5,000, 5,000, and 105,000 in the subsequent 3 years? So all I have to do is plug in these values into the IRR formula. And sometimes it wants you to make a guess in the formula, but I'm not going to do that. I'm just going to close the parentheses and hit enter. And then I'll convert that to a percentage. And you can see that, so if you as an investor invest 97,327 today in a company, and then they make these payments to you over the next 3 years, you will have earned a rate of return on your investment of 6%, which is the rate of return you required, okay? So that's kind of how this works. So I'll leave that 6% there, and now we'll change the assumptions, okay? So now all of these are formula. So if I change my determination of the effective interest rate, all of these formulas will update. So this assumption we made, we said, well, Boosted Board is riskier company. So 5% is not enough rate of return for me to invest in these bonds. Well, now let's assume Boosted Board is a very unrisky company. Okay. 5% is more than I need. Okay. I only need a 4% return on my investment because Boosted Board is just simply not a risky company. How much should I be willing to pay for these bonds then? Well, if I only need a 4% return on my investment, I should be willing to pay more than face value, 102,775. I should be willing to pay more than the face value of the bond to invest in these bonds. And if I pay 102,775 and then receive these future cash flows, I'll obtain a internal rate of return on my investment of 4%. And the final thing I'll show you is, what if investors think 5% is just the perfect coupon rate? That's exactly what I thought rate of return I needed to invest in a Boosted Board bond. So 5% is just exactly what I wanted. Well, if that's the case, then the amount I should be willing to pay is exactly the face value of the contract. Okay. And if I pay 100,000 today and I receive these future payments, I obtain a 5% rate of return. Okay, so that is the basics of how investors are valuing a bond. And what you have to know is, when investors value the bond, say they need a 6% rate of return, this box that's giving you the present value up here, these will be the proceeds to the company. So when the company issues this yellow bond into the market and investors need a 6% rate of return, investors will only be willing to pay 97,327. And so this will be the proceeds to the company under these circumstances. Okay. And so this is how investors value bonds, and it determines what the proceeds will be to the company when the company issues the bond. Okay. I hope this video was helpful, and see you again soon. Bye-bye.